Welcome back to Market Brain, where we dissect the bleeding edge of financial mathematics and technology. Today, we're tackling a concept that sounds almost too good to be true: free money. In finance, we call this arbitrage, and it's the holy grail for some, and a market inefficiency that needs to be stamped out for others. But what if an AI could actively prevent these opportunities, ensuring a mathematically consistent market? That's precisely what we're exploring with a new model called ARBITER. So, what exactly is arbitrage? In simple terms, it's the simultaneous purchase and sale of an asset in different markets to profit from a price difference. Think of it like this: if you could buy a soda for $1 at store A and immediately sell it for $2 at store B, you've just made a risk-free profit. In finance, these opportunities arise from mispricings across related assets, and sophisticated traders are constantly hunting for them. But for markets to be considered efficient, these opportunities shouldn't exist. Mathematically, the absence of arbitrage imposes strict conditions on option prices. For example, the price of a call option, $C, K, T, $, must be a decreasing function of its strike price $K and a convex function of $K. Similarly, prices must behave predictably across different maturities $T. Violations of these rules, like a call option with a higher strike trading for more than one with a lower strike, create an arbitrage opportunity. These are known as static arbitrage conditions, including calendar, vertical, and butterfly spreads. Now, let's talk about the specific instruments ARBITER is designed for: SPX and VIX options. SPX options derive their value from the S&P 500 index, giving you exposure to the broad market. VIX options, on the other hand, derive their value from the VIX index, which measures the market's expectation of future volatility. These two are intrinsically linked. Market movements in the S&P 500 often correlate with changes in expected volatility. Ensuring consistent pricing across both is a complex dance. Enter ARBITER, a risk-neutral neural operator. What's a neural operator? Unlike a typical neural network that learns to map inputs to specific outputs, an operator learns to map functions to functions. Imagine you want to predict an entire curve, not just a single point on it. A neural operator learns the underlying rule for generating that curve, even if the input conditions change. ARBITER takes market states and outputs entire implied volatility and variance curves, ensuring they are arbitrage-free. The risk-neutral part is crucial. In financial modeling, we often price derivatives under a hypothetical risk-neutral measure. This isn't about ignoring risk, but rather about using a mathematical trick where all assets are assumed to yield the risk-free rate. This allows us to calculate expected payoffs without needing to estimate individual risk preferences. The price of a derivative, like a call option, is then the discounted expected payoff under this risk-neutral measure, denoted as $Q$. ARBITER's genius lies in its ability to enforce these no-arbitrage constraints directly during its learning process. It's not just trying to fit the data, it's trying to fit the data while respecting fundamental financial laws. This includes enforcing static arbitrage conditions like calendar, vertical, and butterfly spreads, ensuring Lipschitz bounds for smoothness, and maintaining monotonicity. This means the model isn't just predicting, it's predicting within a framework of mathematical consistency, making its outputs far more reliable and actionable. Why is this relevant right now? Well, today, we're seeing significant movement in the VIX. When the VIX is highly volatile, the implied volatility surface, which is a 3D plot of implied volatility across different strikes and maturities, can shift dramatically and rapidly. In such dynamic environments, maintaining arbitrage-free pricing becomes incredibly challenging. A model like ARBITER ensures that even as the market's perception of future volatility changes, the resulting option prices remain internally consistent and free from free money opportunities, providing stability and reliability. The output of ARBITER is an arbitrage-free term structure or surface of implied volatility. Imagine a landscape where the x-axis is the option strike price, the y-axis is its time to maturity, and the z-axis is the implied volatility. This surface, denoted as $sigma, K, T, $, needs to be smooth and free of dips or bumps that would allow for arbitrage. ARBITER learns to generate this entire surface, ensuring it adheres to all the no-arbitrage conditions across all strikes and maturities simultaneously. The implications of ARBITER are profound. By providing a robust, mathematically consistent framework for pricing SPX and VIX options, it reduces the risk of mispricings, enhances market efficiency, and offers a more stable foundation for hedging and risk management. This isn't just about preventing free money, it's about building more reliable financial models that can navigate the complexities of modern markets, even when volatility is high. It's a testament to how advanced AI is shaping the future of quantitative finance.